Welcome to The Explainer. So today we're diving into one of the most fascinating and honestly kind of bizarre macroeconomic shifts happening right now. We're seeing massive legacy companies, we're talking everyone from century-old automakers to struggling shoe brands, literally abandoning their core business models. And why? Well, they're chasing this explosive physical infrastructure boom around artificial intelligence. It is a total gold rush out there, but instead of pickaxes, these companies are scrambling for server racks and power lines.
Here's the roadmap for our explainer today. We've got 6 parts. First, the global AI bottleneck. 2, from shoes to servers. 3, repurposing hard industrial assets. 4, energized power, the crypto pivot. 5, the infrastructure mimicry bubble. And finally, 6, the approaching AI reckoning. Let's get right into it.
Section 1. The global AI bottleneck, the physical constraints of the generative AI boom.
Okay, so to really understand why a sustainable shoe company or a legacy automaker would suddenly just throw millions or even billions of dollars at AI infrastructure, we have to look at the massive physical and financial bottlenecks in global tech right now. The big one? A severe shortage of high-performance silicon, specifically advanced GPUs. Now, NVIDIA and some major financial institutions have basically engineered this brilliant but risky setup. They've pioneered a structure where physical GPUs actually act as cash-flowing financial collateral. Basically, you spin the hardware into a special-purpose entity, use that to raise structured debt, and then lease the compute capacity out to AI developers. Wall Street is suddenly viewing these chips as hard, leasable assets. So non-tech companies realized, hey, if we can just scrounge up the capital to buy the chips, we can become compute providers. We don't even have to write a single line of AI code.
But here's the catch. Those chips are completely useless without power, which brings us to the second massive bottleneck. AI data centers are incredibly, mind-bogglingly power-hungry. They require exponential multiples of traditional energy. In fact, U.S. power networks are facing such an unprecedented strain right now that it's projected to kick off a massive $1.4 trillion utility capital expenditure cycle through 2030. To put that into perspective, that is a staggering amount of capital. So the bottom line is this. Companies that just happen to sit on underutilized industrial land or have massive grid interconnects, they are sitting on an absolute goldmine. This raw physical reality is forcing a total industrial scramble.
Section 2. From shoes to servers, the Smartbird corporate metamorphosis.
All right, to wrap your head around this absolutely wild corporate metamorphosis, you really just need to look at one staggering number: negative 210%. That was the eco-friendly sneaker brand Allbirds' 5-year average return on invested capital. Just brutal. Their retail model was plagued by continuously shrinking sales and a deeply negative operating margin. It was mathematically unviable for the public markets. So instead of trying to, make better shoes, they completely stripped their identity. They sold off their footwear assets for mere $39 million, essentially hollowing out their entire public shell company.
This timeline really tracks the absolute chaos. They went from a massively hyped sustainable shoe IPO in 2021 straight to a desperate fire sale of those assets by March 2026. Then, barely a month later in April, they announced this completely out-of-left-field pivot to becoming a GPU as a service provider. By June, they formally rebranded the whole company to Smartbird and completely replaced their CEO. And get this, to make it happen, they even took on incredibly toxic 12% interest debt just to try and buy NVIDIA Blackwell servers.
And to really sell the illusion, the board systematically overwrote its own past. I mean, you can't exactly have a retail apparel executive negotiating high-level deals with NVIDIA, right? So they did a total leadership sweep. They brought in Nadia Carlston, an elite enterprise AI veteran who actually launched Denmark's sovereign AI supercomputer. It's a serious resume. But listen to her blunt quote here. She leaned right into the narrative erasure, saying she was blissfully unaware of all things Allbirds, and that in a few months, people won't even remember the shoes.
So how did the market react to all this? With an absolutely shocking 582% intraday stock spike on the exact day of the pivot announcement. I mean, a failing sneaker company literally added over $127 million in market cap in a single trading session. And why? Simply by issuing a press release outlining a GPU leasing strategy. The market wasn't pricing in the immense execution risk here. It was entirely 100% pricing a narrative.
Moving on to Section 3, repurposing hard industrial assets. The Ford energy pivot.
Now, it's important to note that not all of these pivots are just asset-light illusions propped up by 12% debt. Let's take a look at what a physically grounded, real asset-backed transition to the AI economy actually looks like. When consumer EV demand hit a massive wall throughout late 2024 and 2025, Ford had to make a tough call. They dissolved an $11.4 billion EV battery joint venture. That left them with this massive, wildly underutilized, state-of-the-art manufacturing plant in Kentucky. But rather than just taking a total loss on it, Ford decisively repurposed that space. They committed $2 billion to launch a brand new subsidiary called Ford Energy, and its sole purpose? Manufacturing grid-scale battery energy storage systems.
Their flagship product is the Ford Energy DC Block. It's a 20-foot containerized energy storage unit. Now, what's fascinating is they shifted their battery chemistry to lithium iron phosphate, or LFP cells. In a car, LFP batteries are way too heavy. But for a stationary AI data center, physical weight doesn't matter at all. What matters is that they don't catch fire, and they last practically forever. Ford engineered these massive units to hold 5.45 megawatt-hours of capacity, specifically designed for a 20-year performance life. And that is exactly the kind of bulletproof stability these power-starved hyperscalers are desperately looking for.
When we put SmartBird and Ford Energy side by side, the contrast is just night and day. On one side, you have a narrative asset. It's entirely driven by rebranding and high-cost 12% debt, with literally zero historical background in tech hardware. On the other side, you have a true physical asset. Ford is leveraging a century of industrial manufacturing expertise, utilizing existing industrial zoning, massive battery lines, and actual energized grid access. Unsurprisingly, Wall Street absolutely loved Ford's move. Analysts are already valuing this new energy segment at up to $10 billion as a standalone entity.
Section 4. Energized power. The crypto pivot. Turning Bitcoin mines into AI hubs.
Now, for the crypto miners out there, this whole trend comes down to one thing: pure unit economics. See, Bitcoin miners historically secured these massive, cheap, pre-energized land packages. When the AI compute boom kicked off, they spotted an incredible arbitrage opportunity. Just look at the breakdown here. AI compute contracts generate roughly 3 times the revenue, taking up 75% of the pie on a per megawatt basis compared to the 25% from traditional, volatile crypto mining. So for them, it was an absolute no-brainer to start upgrading their facilities from crude mining sheds into high-end Tier 3 data centers.
The absolute apex of this crypto pivot trend has to be Core Scientific. They use their massive, uninterrupted power capacity to lock in a multi-year 200 to 270 megawatt hosting deal with CoreWeave. And here's the crazy part. When CoreWeave realized just how incredibly valuable that energized power was, they tried to buy Core Scientific outright for $9 billion. And Core Scientific said no. They rejected it. Their underlying power access was simply worth more. Wall Street has fundamentally stopped valuing these companies based on Bitcoin hash rates. Now, it's all about their gross energized power.
Section 5. The infrastructure mimicry bubble. Repeating financial history.
You know, whenever billions of dollars start sloshing around a new trend, financial history perfectly repeats itself. Let's look at some past speculative bubbles. Back in the 1998 dot-com boom, a fish protein company rebranded to Zap.com and saw its stock surge 1,200% before ultimately crashing to zero. In the 2017 crypto craze, a beverage manufacturer literally slapped blockchain onto its name, becoming Long Blockchain Corp., and surged 300% before the SEC had to step in. And today, we've got SmartBird pivoting from wool footwear and failing social media apps like MyVM just tacking .ai onto their names. They capture these sudden massive valuation spikes completely without the actual expertise to back it up.
Section 6. The approaching AI reckoning. The systemic risks of the pivot economy.
Here's the thing, though. Unlike past eras where throwing up a basic .com website or publishing a blockchain white paper cost practically nothing, mimicking an AI infrastructure firm today requires tens of millions in hard, upfront capital. Which brings us to the ultimate question hanging over the entire market right now. Will the AI pivot actually pay off? Can these highly financialized, debt-heavy maneuvers survive the brutal, capital-intensive reality of the tech sector?
The systemic risks here are incredibly severe. First, you have rapid hardware obsolescence. NVIDIA architectures depreciate incredibly fast. If you're leasing that hardware using high-interest debt, you are racing a ticking clock before those chips are old news. Second, those toxic debt traps. Servicing 12% interest notes demands immediate, high-margin leases just to keep the lights on. Third, the hyperscaler threat. Giants like Amazon, Google, and Microsoft are already developing their own custom proprietary silicon. And finally, the execution gap.
Designing complex liquid-cooled logistics fundamentally clashes with the legacy DNA of a consumer goods company. They just don't have the experience.
And that brings us to the core takeaway of this explainer. The market is going to be brutally unforgiving. It will punish those who are unable to execute the grueling, capital-intensive reality of physical AI infrastructure. We are looking at a deeply bifurcated economy. Asset-heavy corporations like Ford and Core Scientific are building genuine physical moats that address real infrastructure deficits. But the mimetic pivots, the shoe brands and the failing apps, they are exposing their shareholders to immense capital ruin.
So I want to leave you with this final provocative thought. The market might be eagerly pricing in a narrative today, but tomorrow it is going to demand real cash flow. As this narrative premium inevitably fades away, who will be left holding the essential physical assets that actually power the future? And who will be completely crushed under the weight of their own corporate illusions and toxic 12% debt? Think about that the next time a legacy retail brand suddenly announces a grand AI transformation. Thanks for joining me for this explainer. Keep learning, and we'll catch you next time.